Assalamualaikum and salam sejahtera to everyone. My name is Akila binti Darwis and my matric number 299024. I will present for introduction and overview. So this study focuses on how war and geopolitical risks influence marine insurance premium and underwriting practice in the global maritime industry. Maritime trade plays a crucial role in the global economy as more than 18% of the world trade is transported by sea. However, shipping activity are exposed to various risks such as natural disaster, operational accident, and political conflict. These risks create significant financial uncertainty for ship owner, cargo owner, and other stakeholders. In this context, marine insurance acts as an essential safeguard by protecting maritime assets against financial loss and ensuring the smooth continuation of international trade. Okay, next from marine insurance overview. Okay, so marine insurance is a specialized brand of insurance that protects maritime assets and operations from financial loss. Unlike general insurance, it focuses specifically on maritime interests such as vessel, cargo, fleet, and third-party liabilities. There are several main types of marine insurance. So first, we have hull and machinery insurance, cover physical damage to ship and their machinery. Next, we have cargo insurance that protect goods in transit. Next, we have protection and indemnity insurance that cover third-party liabilities such as crew injuries and pollution. And the last one, we have fleet demurrage and defense insurance that address legal and contractual disputes. So, marine insurance operates through underwriting, where insurers assess risk to determine coverage and premium. So, by understanding its main type, how it operates, and the role of underwriting, provide a basis for analyzing how external factors such as war and geopolitical tension affect insurance premium and risk management.
Good morning, doctor, and my fellow friends. My name is BWRRK3083 and my matrix number is 299984. Today, I'll be talking about war risk and geopolitical risk. First, we'll talk about war risk. War risk is a risk that will arise when the acts of war or hostility happens, which includes losses that are typically excluded by the standard marine insurance policies, especially those losses that fall under clauses like free of capture or seizure. Well, there are various types of war risk. First, let's talk about the civil war. Civil war was a politically organized and large-scale physical violent conflict that happens within a country among large important groups of citizens over the monopoly of physical force within the country. Furthermore, a civil war is not only a large group of people that make trouble for the government and undermine security over a sufficient long time, but also entail a large-scale and sustained internal political violence to distinguish the government from attacks, such as political assassinations. Furthermore, terrorism is a type of action that is designed to have a strong psychological impact and must involve violence or the threats of violence. This is because the terrorist acts are often known to be random in nature, but also intended to select the targets that can provoke the maximum reactions to strike at the symbol of the regime. Other than that, piracy is an illegal act of violence or detentions that was committed for private motives by persons on a private ship against another ship, person or property on the high seas or in a place outside the jurisdiction of any states. Well, lastly, riot is a situation of a large group of people behave in a violent and uncontrolled way. Okay, so that among all of those public disorders events that has occurred around the world in recent years, the one that was most media-worthy was the riots across the United States that followed the death of George Floyd at the hands of police in 2020. In this case, those protests had been causing vandalism in more than 100 cities across the country, causing a cost of estimated $1.5 billion into the insurance industry. Furthermore, I would like to talk about the marine war risk insurance coverage. Well, according to claimants, the coverage of marine war risk insurance including hull cover, cargo cover, breach of warranty cover, and hull interest. We'll talk about the hull cover first. Well, for the hull cover, it was the policy coverage that protects against physical loss or damage to the vessels that were caused by the acts of war, strikes, riots, civil commotions, captures, seizures, arrests, or detainment, weapons of war, and piracies. Next one is the cargo cover. Cargo cover is a policy coverage that covers the loss of damage to goods due to war-related perils, and it was typically governed by the institute war clauses, while hull interest is the additional covers that supply the initial value of the vessel to ensure there were full indemnity when total loss happens. Lastly, for the breach of warranty cover, it was a protection for the situation of a vessel entering a war zone in a breach of trading warranties, subject to prior notice and additional premiums. It was also important to take note that terrorism and kidnap and ransom are often excluded from the standard war policies and need to separate or specialize policies. Now, let's take an overview on Institute War and Strikes clauses. Institute War and Strike clauses covers situations like civil war, revolutions, rebellions, and any other large scale inside the country, and also including attacks or hostilities from another countries. Moreover, it also has coverage on people that are being captured, seized, arrested, detained, or detained due to the war-related events. Those old and abandoned weapons from war such as mines, torpedoes, bombs that might be still out there, and dangerous were also covered in Institute War and Strike clauses. However, war on land risks are not covered, referring to the Waterborne Agreement 1-1-82. So it was crucial to determine that either the loss on land is due to the insurrections due to Lloyd. If it was strike risk, it was covered. But if it was war risk, it was not covered. In addition, the terrorism cover provided by the strike clauses is limited to the maximum of 60 days post-discharge under JC 56. For now, we shall go further to the geopolitical risk. Geopolitical risk is the risk that comes from political events, conflicts, or even policy changes that have caused disruptions to the markets, economies, and supply chains globally. So now let's talk about the various types of geopolitical risks, but we are going to talk about three of them, which was trade transactions, port states, and maritime choke point. Well, for the trade transactions, it was the type of economic policies tools that were used for the enforcement of political, economic, or social change by countries or international organizations. Trade transactions are also usually imposed by a country or a group of countries come against another so that they could achieve their specific motive or national security goals. It was also important to take note that trade sanctions are diplomatic and economic tools that fall short for military actions, but were more severe compared to the verbal condemnation. Other than that, another geopolitical risk is the instability of port states, which are the vulnerability of global trade infrastructure toward the internal political, social, and economic volatility within the host nations. This will create a crucial geopolitical risk for the global supply chain because the instability of port state may lead to sudden port disclosure or severe congestions that further affecting the supply chain, causing blockage and significant delays in the movement of goods. Well, lastly, we'll talk about the maritime choke point, which was the strategic and narrow passage that are used for the connection of two larger areas and serve as critical water paths, facilitating the international trade. All of those various types of political tensions will cause blockage, attacks, militarizations, and disrupting the maritime choke points. This will lead to the danger of threatening supply chain, energy security, and economic stability for the entire world.
My name is and my metric number is 299016. So I will be presenting on war and geopolitical risks, focusing on global hotspots and their impact on marine insurance and global trade. What are global hotspots and why they matter? Global hotspots refer to regions affected by war, political conflict, or geopolitical tension. These areas are important because they increase risk to commercial shipping, disrupt trade routes, and significantly raise marine insurance costs. In this report, we identified 3 cases related to war and geopolitical issue, namely the Black Sea, the Red Sea, and then the South China Sea. So for the first one, Black Sea, and then the country that involved in this is Russia and Ukraine. The Russia-Ukraine war has turned the Black Sea into the high-risk zone. Commercial vessels face threats such as attacks, blockades, and damage reports, causing war risk insurance premiums to rise sharply and forcing ship owners to avoid the regions. The second one is the Red Sea. The Red Sea has become risky due to attacks by Houthi rebels on commercial vessels. As a result, many ships avoid the Suez Canal and take a longer route, leading to higher shipping costs and increase the insurance premium. And then the third one is South China Sea. The South China Sea is highly disputed by several countries. Malaysia is one of the countries that involved. Although trade continues, rising geopolitical tensions has increased perceived worries, causing insurers to raise premiums and apply stricter underwriting conditions. It gives impact on marine insurance and a global trade. So these geopolitical risks have led to higher war risk premiums, reduced insurance capacity, and increased operating costs. Delays, longer routes, and higher shipping expenses ultimately affect global supply chain. In the conclusion, global geopolitical hotspots significantly influence the marine insurance pricing and international trade. Managing this risk is crucial to ensure safe navigation and the stability of global commerce. Thank you.
Good day everyone, myself Lishmi Sri Anapurban Saravanan, battery number 301922. Today I'm going to talk about influence of marine insurance premium. First, the calculation of maritime insurance premium. The insurance premiums are calculated based on risk assessment. Underwriters assess the likelihood and severity of possible losses. The age, type, flag state, and condition of the vessels are evaluated. Newer vessels with good safety records usually pay lower premiums. The voyage route, distance, and part of all call affect the premium. Voyage through unstable or piracy-prone areas have higher premiums. The type and value of cargoes influence insurance costs. Hazardous or high-value cargo increase the premium. Ship owners with good claims history pay lower premiums. Compliant with SOLAS and the ISM codes reduce insurance costs. Next, war risk surcharge in marine insurance. A war risk surcharge is an extra premium charged for war-related risks. It covers risks such as war, terrorism, missile attacks, and naval mines. War risks are not covered under standard hull and cargo policies. The surcharges applies when vessels operate in conflict areas. It's usually charged as a percentage of vessel's insured value. The surcharges may be charged per voyage or a fixed period. War risk surcharges increased during the Russia-Ukraine conflict. High-risk maritime areas. High-risk areas are regions exposed to war, piracy, or political instability. These areas are identified by insurance organizations such as the Joint War Committee. Vessels operating in high-risk areas face a higher insurance premiums. Insurance coverage is often more limited in high-risk regions. Note that the Red Sea and Gulf of Aden area are considerably high-risk areas. The Black Sea remains high-risk due to Russia-Ukraine war. Ship owners may reroute vessels to avoid high-risk areas. Rerouting increase travel, distance, and fuel costs. Insurers may reduce coverage or refuse certain voyages. At last, impact of rising geopolitical tension on premium. Conflict threatens important maritime trade routes. Key affected routes include the Strait of Hormuz and the Suez Canal. Increased risk leads insurer to raise premium rates. Underwriting becomes stricter during geopolitical instability. Insurer may reduce coverage limits and add exclusions. Recent attacks in the Red Sea cause insurer to reassess risk. Ship owners face higher operating and insurance costs. Geopolitical risks have become a major factor in maritime underwriting. Thank you.
Okay, next I will share with you the actual example, real price changes, and the recent event for the impact of war and geopolitical risk on marine insurance premiums. For the first part is Red Sea crisis. Red Sea crisis happened because of the Houthi attack and the marine insurance fear for the further attacks, so the war risk rates increased for about 0.7% to 1.0%. As the cap of good hope causes more, so the marine insurance reward use Red Sea with increases rates. Next is Russia and Ukraine. That is the Black Sea. It happened because Ukraine attacked the tanker that drive to Russian port. It causes the conflict between these two countries, which Ukraine restrict the Russian oil revenue. For Ukraine port, the war risk rate is around 0.5% to 0.75%. Next, for Russia port, the war risk rate is 0.6 to 0.8%. And the last part is South China Sea and Taiwan Strait. The conflict happened because South China Sea acts as an important corridor. It costs over 5 trillion revenue for the operations, and the conflict is the country has heavily contested territorial claims. And for the war risk rate, the war risk premium has increases 20% and above. That's all for me. Thank you.
My name is Liao Xingyong, matrix number 29710. I'm going to present about the influence on underwriting practices. There are 4 parts, which is enhanced risk assessment, policy changes, reinsurance impact, and security and compliance requirements. So the first part is enhanced risk assessment. Underwriters can increase documentation, requires the underwriters to show certificate to prove the vessel maintenance record. And the second is satellite tracking requirements. It can monitor location and movement of the vessel continuously. Third is updated route planning, to request route of each ship to avoid ship visit in war zones. And the fourth is political intelligence briefings to help underwriters to receive information from government defense agencies. And the next is policy changes. So there are 4 parts. There are also 4 parts, and which is exclusion from certain waters. If there's a loss happening in excluded water, it will not be covered. And the second is voyage-based underwriting to provide coverage based on voyage routes vessel will visit. Third is restrictive cancellation clauses to protect insurance from long-term exposure to rapidly changing political risk. And the fourth is additional endorsements to automatic termination of covered endorsement when the vessel enter high-risk exposure zones. The third is insurance impact. When reinsurers pull out from the market, the primary insurers will raise the premium price because it costs the primary insurer retain higher level of risk. For example, Russia-Ukraine war in Black Sea region. And the next is global reinsurance in London and Europe influence pricing because they are major reinsurers from London and Europe. So when they're doing some adjustment from the market will significantly influence over the marine pricing worldwide. For example, geopolitical developments in Eastern Europe or the Middle East often cause global premiums adjustment. And the fourth part is security and compliance requirements. So the insurance company can require the vessel to have armed guards to reduce the probability of hijacking or crew harm. And the next is Naval convoy coordination to mandate coordination with Naval forces. For example, the Naval forces can doing escort arrangement in war zones. And the next is AIS monitoring to ensure the continuous vessel visibility. And the last is cybersecurity protocols to counter cyber warfare attacks. That's all from me. Thank you.
I will present the case study, which is the impact of Russia and Ukraine war on marine insurance in Black Sea. The Russia and Ukraine war, which started in February 2022, caused serious disruption to shipping activity in the Black Sea. This area is very important for shipping routes, especially for grain and oil. Because of the war, ships face high risks such as port attacks, sea mines, and movement restriction. As the result, marine insurance premium, especially war risk premium, increased sharply. In some cases, the premium become very expensive, which increased shipping costs and reduced profitability for shipping company. Underwriting practice also become strict. The Black Sea was classified as high-risk area, so ship owner had to buy separate war risk insurance, and some insurers reduced or stopped coverage in these regions. In conclusion, this case shows that geopolitical conflict has a strong impact on marine insurance, leading to higher premium, stricter underwriting, and disruption to global trade. Since late 2023, the Red Sea has become a high-risk area because of repeated attacks on commercial vessels. This has caused insurance companies to raise war risk premium and apply stricter rules for coverage, which directly affect the shipping company. First, shipping company will face financial burden. Higher insurance costs plus extra spending on security and safety measures make operation more expensive, especially for small companies. Second, many ships now use another routes to avoid Red Sea. These longer routes mean more costs, higher crew costs, and extra operating expenses. Third, this can lead to delay in shipping schedule. Longer routes and security checks slow down delivery time, which can affect contracts and customer satisfaction. Fourth, freight charges increase because companies pass this higher cost to customer, which also can rise the price of goods in the market. Finally, these challenges can disrupt supply chain and reduce competitiveness. Some companies may even avoid the high-risk routes entirely, leaving bigger firms to dominate the market. In conclusion, war and geopolitical risk increase insurance costs, delay shipping, disrupt supply chains, and make it harder for companies to compete. Shipping companies must carefully manage this risk to stay efficient and profitable.
I will be presenting about the conclusion and the recommendation for this report. So to conclude, this report has examined how far the war and geopolitical risk significantly influence the marine insurance premiums and underwriting practices. As discussed, the maritime industry is highly exposed to political instability, armed conflict and security threats, particularly in strategic regions such as the Black Sea and the Red Sea and the South China Sea. These risks increase uncertainty for insurers and led to higher insurance costs. In response to these risks, marine insurers impose war risk surcharges and classify certain regions as high-risk areas. At the same time, underwriting practices become more stringent with stricter risk assessments, exclusions for specific routes, and voyage-based insurance coverage. These changes directly affect shipping companies by increasing operational costs, causing route diversions, delaying schedules, and contributing to supply chain disruptions. Overall, the findings highlight that marine insurance is highly sensitive to geopolitical developments and plays a crucial role in maintaining the stability of global maritime trade. Based on the findings of this report, several recommendations can be made. Firstly, shipping companies should ensure that they obtain adequate war risk insurance coverage and conduct regular reviews of their insurance policies, particularly when operating in regions exposed to geopolitical instability. Effective voyage planning and the use of updated geopolitical and maritime intelligence can help reduce exposure to high-risk areas. Secondly, shipping companies should strengthen risk mitigation measures by enhancing vessel security, complying with international maritime safety standards, and maintaining transparent communication with insurance. These measures may improve their risk profile and facilitate more favorable underwriting terms. With the insurer's perspective, continuous monitoring of geopolitical developments and close collaboration with reinsurers and maritime security organizations are essential. A coordinated approach among the insurers, shipping companies, and regulatory authorities is necessary to ensure the resilience and continuity of global maritime trade.